Hi everyone, welcome back to my Nelnet coverage, and today we're diving deep into management. I think this is a really key part of the business. We'll also try to look at the runway for growth, reinvestment rates, and get ready for evaluation. Now, for those of you who are looking for a broker, I use Interactive Brokers. It's the one that I would highly recommend. They have access to many of the international markets. Their fees are low, they're stable, they're reliable. Links in the description below, and I have demo videos here on the channel for that. Let's jump into management and talk specifically about Mike Dunlap, who is the chairman, and the CEO is Jeff Nordhoek. I'm going to refer a lot to these two guys. They were college roommates initially, and they've been with Nelnet for decades. So the first thing I'm going to look at is the chairman's letter from Mike Dunlap, and I think I'm going to try to highlight some things that give us the impression of who he is as a person and what this business is like. Okay, let me just read this. This is Mike Dunlap's thoughts. He said, "Our goal is for each Nelnet shareholder to record a gain or loss in market value proportional to the gain or loss in per share fundamental or intrinsic value recorded by the company." So what does that mean? Well, that means that he's essentially hoping that the stock price moves with the intrinsic value of the business. And that's what they're actually trying to do. They don't want things to get overvalued or too undervalued. And he goes on to say, to achieve this goal, we strive to maintain a one-to-one relationship between the company's fundamental value and the market value. As that implies, we would rather see Nelnet stock price at a fair level than at an artificial level. Our fair value approach may not be preferred by all investors, but we believe it aligns the Nelnet's long-term approach to both our business model and market value. However, from time to time, he says Mrs. or Mr. Market can be irrational and will materially overvalue or undervalue the investment style they currently love. Short term, Mrs. or Mr. Market is a voting machine, and the long term, the market is a weighing machine. I think this is really interesting how they've got a long-term approach, and it's a very unusual approach. And I think it's cool that they don't want an outrageous stock price. That's great to see. They're not rewarded on the price going up 50x. They're rewarded from their bonuses. Like, it would be cool to see that happen, but they know that's overvalued and non-sustainable, and they want this to be a long-term sustainable thing. So they don't want the whipsawing of massive like overvaluation, undervaluation that the market can provide. They're trying to just stay with the intrinsic value of their business. And I think that's beautiful. I think that's exactly what businesses should be focusing on. Unfortunately, they can't control the market, so they don't have a choice. So all they can do is explain what they would like and hope that the market calms itself down to between what they around about intrinsic value. Now, this table is Nelnet's corporate performance and annual percentage change. And we're going to look at Nelnet per share book value with the dividends included. The compound annual growth rate in total since 2004 has been about 17% per annum on average. Their per share market value with the dividends included has lagged this at only about 10%. So essentially this is saying that the share price hasn't been keeping up with the growth of the book value per share, which is interesting. And then they've got over on the far side, net income reinvested, and we'll go through how much has been reinvested in where a little bit later, but it's cool that they highlight how much money they're reinvesting per year. I think you can see by this that it's lumpy. Some years, like in 2012, they only invested 89 million, but the next year was 271. And then the year after was 273. Then in 2017, it's back down to 80. So it's a little bit all over the place. They're a little bit opportunistic. And I think this highlights sort of the overall strategy of that reinvestments can be lumpy, but if you look over a long enough period of time, the compounding effect of the book value per share has been very strong. So let me read the CEO, Jeff Nordhoek's comments on how there is the book value of the company maybe is understated. He says, "The purpose of this letter is to provide you with an overview of the various ways we are creating value throughout the organization, which may not be apparent as they are not yet fully reflected in our balance sheet or in the income statement. It's no secret that Nelnet is complex as we continue to diversify." That's good that they acknowledge that they are complex. "Our financials reflect short-term book gains and losses, and we think and operate using a long-term horizon." So he's saying that there is fluctuations in the book value of the business, but they're thinking long term. And because of this strategy, many areas of the value do not appear in today's financials, but we are confident they will down the road as we continue to play the long game. So examples include the continued investment in a lot of their areas, but even with that investment in those areas, the accounting rules require that we book upfront losses on these investments. We know we are creating long-term value. This can adversely impact the near-term GAAP earnings and create choppiness in our year-to-year earnings, but we are bullish and excited about the prospects of all these businesses. So their GAAP earnings are short-term, it's going to short-term up and down a little bit, but it's because they're making investments for longer-term things. For example, they're putting money into a solar project. So all this money is going out of the business and it looks like they're not making much profit or whatever it is. They have to book these losses and expenses up front, but the payback time is years down the road. So that kind of messes up the GAAP numbers a little bit and doesn't really reflect the true value creation of the business. So here's an example. He said, let's review our current investment in Huddle, which was $134 million as of December 31st, 2022. So that's how much money they've invested in that business. Huddle's most recent equity raise back in May 2020, so 3 years ago, was considered an observable market transaction for the accounting purposes. And as such, we increased our carrying value of Huddle, resulting in a $51 million gain. They purchased additional shares in Huddle from existing shareholders for another $32 million. The purchase of these shares was not an observable market transaction. However, since the transaction on May 2020, 3 years ago, we are confident that the fair value of Huddle has increased in those 3 years, obviously, because it's been growing. And we believe our carrying value is substantially less than its market value. So what they've got it on the books for is 134 million. That's what it got valued at 3 years ago. They're a 3, 4, 5 times bigger business now. It's going to be worth a lot more than $134 million at the moment, their stake. So there's some not so obvious hidden value here in this business. And if you read through the shareholder letter in detail, you'll find that there's actually other areas as well, like the tax credits in the renewable energy business and some of the other things that they've been investing in. There's a lot of hidden value here. Now, the next thing I want to show you is the capital deployed by year, and that's what this table is representing here. We've got all the different segments of the business, including debt repurchasing, stock repurchases, and dividends. And you can look at each year how much money is getting invested, deployed into each of these areas. We can see the 10-year total over here might be a little bit interesting. So we can see that, like, for example, Nelnet Bank, they put $130 million and they put in $100 million in 2020 to get it off the ground, and they put in another $30 million recently. We can look at the Huddle investment. They back in 2014, like seed money, they put $1 million in, then it was 41 million, then 10 million, then 26 million, then 5 million. They've been adding along the way to a total 10-year deployed capital of 83 million as of 2022. And we can see how much the 10-year total of capital deployed has been. This is really interesting, and a lot of businesses don't go to this granular detail of where they deploy their capital and how much exactly. This is fantastic for us to see when we're looking at valuation. We can look at, well, they've put in 7 billion into all these different areas. What are they worth today? And we can have a look when we go through valuation about this, but this is really cool to see how they're deploying their money. Now, I know I'm going on about management a lot, but this is really important to this thesis, is how good the management are. And you've really got to get an understanding of this because there's going to be a bit of trust involved. And I'll explain a little later why some of this is a bit of a black box, and getting management commentary is really important here. So I'm looking at some questions and comments that Mike Dunlap did in a recent interview. Now, the question was, can you talk about what you see in solar and alternative energy financing? Why is this a good or natural business for Nelnet to be in? He answered, it is fairly complicated financing, and we have developed an expertise in the tax equity world, which we are leveraging deeper into solar. It is a long-term asset like student loans and fiber that creates good cash flow. This is him essentially explaining money is going to be spent up front for the long-term benefits of the future and the cash flow that's going to come from this project. So I love that they're thinking long-term. Now, I think this question and answer is actually really important. Question 8 here on this document, it says, in the past, Nelnet primarily repurchased shares below book value, and now you are consistently buying above book value. Does this have anything to do with what was mentioned in the annual letter about the difference between the true market value and book value, or is it more to do with the opportunity? Mike answered this. We deploy cash a number of different ways, growing our own businesses, adding bolt-on acquisitions, unrelated acquisitions, dividends, and stock buybacks. Depending on any point in time, we may have excess cash or need to borrow to fund our growth. All these factors figure into the decision to buy back our stock. Some of the GAAP accounting treatment we receive on some of our assets we think may undervalue them based on book value accounting. The bottom line is we buy back the stock when we have a long view sight on having excess cash and we think the price is attractive. And they have been buying back stock. So I think this is a hint towards the hidden assets, the hidden value of this business. There's a lot more in this. I could go through all of these and I could go through these in more detail and discuss them all, but I think I'm just going to leave a link in the description below for this particular Q&A with Mike Dunlap. It is fascinating. Read it 3 or 4 times if you can. You'll get a lot of insight into how these guys think. All right, so this has gone on a lot longer than I expected. I think I just wanted to talk a lot about management because it's so important to this thesis. And in the next episode, we'll go through some of their numbers. We'll look at their growth opportunity, some of their risks, the competitors, a yellow flag that I found, maybe not a red flag, but definitely a yellow flag. And then we'll finally get to a evaluation. I'm sure we're going to get there soon. It's taking longer because it's a pretty complicated business, but it's worth the effort, as you'll see by the end. So I hope you're enjoying. Stay tuned for the next one, and I'll see you then.